In December 2001, a company worth $70 billion filed for bankruptcy in just 24 days. 20,000 employees lost their jobs overnight. Retirement accounts holding $2 billion in savings simply vanished. But here's what should terrify you. This wasn't some startup or risky venture. This was Enron, America's seventh largest corporation, named America's Most Innovative Company, 6 years in a row by Fortune magazine. The collapse didn't just destroy Enron. It took down Arthur Andersen, one of the world's big 5 accounting firms, a company that had survived the Great Depression and 2 world wars. 89 years of reputation, gone. 28,000 accountants lost their jobs because of one client. Today, you're going to learn exactly how fake revenues, hidden debt, and imaginary profits fooled the smartest investors on Wall Street. More importantly, you'll understand the warning signs that were hiding in plain sight, the same red flags that could protect your investments today. If you want to understand the economic stories that shaped our world while most people weren't paying attention, hit that subscribe button and ring the notification bell. This channel uncovers the financial events you slept through. And trust me, understanding Enron could save your retirement account someday. Chapter 1. From Pipelines to Paper Profits. To understand how Enron fooled everyone, you need to understand what they were supposed to be. In 1985, 2 pipeline companies merged to form Enron, a boring utility company that moved natural gas through pipes. Think of them like a toll road for energy. They charged fees to transport gas from producers to consumers. Simple, predictable, boring. But CEO Kenneth had bigger dreams. In 1990, he hired Jeffrey Skilling, a McKinsey consultant with a radical idea. Instead of just moving gas through pipes, why not trade energy like stocks? Skilling convinced that Enron could become the gas bank, buying and selling energy contracts the way Wall Street trades securities. Here's where it gets interesting. Skilling brought something called mark-to-market accounting to Enron. Let me explain this simply. Imagine you sign a contract today to deliver pizzas every Friday for the next 10 years at $20 per pizza. Under normal accounting, you'd record $20 of revenue each time you actually deliver a pizza. But mark-to-market lets you calculate all the money you expect to make over 10 years and record it as profit today. So if you expect to deliver 52 pizzas a year for 10 years at $20 each, you could immediately claim you made $10,400 in profit, even though you haven't delivered a single pizza yet. The SEC actually approved this for Enron in 1992. This single decision would enable everything that followed. By 1996, Enron wasn't just trading gas anymore. They were trading electricity, water rights, weather derivatives. They even tried to trade broadband internet like it was a commodity. Skilling, now president and COO, pushed the company to act more like an investment bank than an energy company. Employees were ranked every 6 months, and the bottom 15% were fired, creating a culture where showing profits mattered more than making them. The transformation seemed to work brilliantly. Enron's stock price rose 311% from 1990 to 1998. Wall Street analysts couldn't get enough. The company reported revenues of $31 billion in 1998, then $60 billion in 1999, then $100 billion in 2000. Fortune magazine named them America's Most Innovative Company 6 years straight. Chapter 2. The Magic Money Machine. This brings us to the creative accounting that would destroy 2 companies. Remember mark-to-market accounting? Enron's traders started using it for increasingly ridiculous things. They signed a 20-year deal to supply power to Indiana. Using mark-to-market, they immediately booked $110 million in profits. But here's the problem. They based those profits on their own internal projections. When the real profits came in much lower, they couldn't admit it without restating earnings. So CFO Andrew Fastow created a solution, Special Purpose Entities, or SPEs. Think of these like separate companies that exist only on paper. Normally, if you have a bad investment losing money, it shows up on your financial statements. But if you sell that bad investment to an SPE, it disappears from your books. The loss becomes someone else's problem. Here's where it gets truly insane. Fastow created SPEs with names like Jedi, Chuko, LJM1, and LJM2. He then did something that should have been illegal. He made himself the manager of these SPEs. So Fastow was simultaneously Enron's CFO and the person running the companies Enron was secretly doing business with. Between 1999 and 2001, Fastow personally made $45 million from these SPEs while still collecting his Enron salary. These SPEs bought Enron's bad assets, hid Enron's debt, and created fake profits. If Enron had a power plant in India losing money, they'd sell it to an SPE. If Enron needed to show profit at the end of a quarter, they'd sell something to an SPE at an inflated price. By 2000, Enron had created over 3,000 SPEs. Their real debt wasn't the $13 billion on their balance sheet. It was closer to $38 billion. But here's what should have been the biggest red flag. Nobody could explain how Enron actually made money. In 2000, a Fortune reporter named Bethany McLean asked a simple question. How exactly does Enron make its money? She couldn't match the reported profits to any actual business operations. When she called Enron for clarification, Skilling personally called her editor to complain, calling her questions unethical. The stock market didn't care about these questions. By December 2000, Enron's stock hit $90 per share. The company was worth $70 billion. Kenneth was friends with President George W. Bush. Enron executives were cashing out stock options worth hundreds of millions while telling employees to keep buying shares for their 401k retirement accounts. Chapter 3. The Asshole, Heard Around Wall Street. The unraveling began with one man named Jim Chanos, a short seller who made money betting against overvalued companies. In late 2000, Chanos noticed something odd. Enron's return on capital was only 7%, but they were borrowing money at 9%. Think about that. They were paying more to borrow money than they were earning from investing it. It's like paying 15% interest on a credit card to invest in something earning 10%. You're guaranteed to lose money. Then came the conference call that changed everything. On March 5, 2001, Fortune published McLean's article titled, "Is Enron Overpriced?" During Enron's quarterly earnings call in April, Skilling was rattled. When hedge fund manager Richard Grubman asked why Enron didn't provide balance sheets with their earnings, Skilling lost his composure and called him an asshole on the public call. Professional CEOs don't do that. Wall Street started paying attention. On August 14, 2001, Jeffrey Skilling suddenly resigned as CEO after only 6 months in the position, citing personal reasons. He had just sold $60 million in Enron stock. The stock price dropped from $45 to $39 in one day. Employees were terrified, but Ken returned as CEO and told them everything was fine. He even encouraged them to buy more stock for their retirement accounts. Then Sharon Watkins, an Enron vice president, sent an anonymous letter to Ken. "I am incredibly nervous that we will implode in a wave of accounting scandals," she wrote. She detailed how the SPEs were hiding losses and warned that Fastow's involvement was a massive conflict of interest. Lay's response? He asked Enron's law firm to investigate, the same law firm that had approved the SPEs in the first place. On October 16, 2001, Enron announced a $638 million loss for the third quarter and reduced shareholder equity by $1.2 billion. But they buried the real news in the fine print. They were under SEC investigation. The stock fell to $33. 2 days later, Fastow was forced to take a leave of absence. The Wall Street Journal revealed he had personally made $30 million from the SPEs. October 24th brought the death blow. Enron fired Fastow and admitted they might have to restate earnings back to 1997. Think about what that means. 5 years of financial statements were lies. The stock crashed to $16. Chapter 4. 24 Days to Zero. Once the truth started emerging, the collapse happened at breathtaking speed. On November 8, 2001, Enron admitted they had overstated profits by $586 million since 1997. The SEC upgraded their inquiry to a formal investigation. The stock fell to $8. But here's where Arthur Andersen enters the death spiral. Andersen wasn't just Enron's auditor. They were practically business partners. In 2000 alone, Enron paid Andersen $52 million, $27 million for auditing and $25 million for consulting. Andersen had an entire floor in Enron's Houston headquarters. They signed off on every financial statement, approved every SPE, and never raised public concerns. When the SEC investigation was announced, Andersen partner David Duncan ordered his team to start shredding documents. Between October 23rd and November 9th, they destroyed tons of paper and deleted thousands of emails. They even called in extra shredding trucks. This wasn't cleaning up old files. This was destroying evidence. On November 28, 2001, the major credit rating agencies downgraded Enron's debt to junk status. This triggered $4 billion in hidden obligations that came due immediately. Enron's stock fell to 61 cents. On December 2, 2001, Enron filed for bankruptcy. At the time, the largest bankruptcy in American history. 20,000 employees lost their jobs immediately. Many had their entire retirement savings in now worthless Enron stock. The human cost was staggering. Employees had been blocked from selling Enron stock in their 401k accounts during the final weeks while executives cashed out hundreds of millions. Charles Prestwood, a pipeline worker who had been with the company 33 years, lost $1.3 million in retirement savings. He had to go back to work at age 68. Thousands of similar stories emerged. Meanwhile, Arthur Andersen was finished. On January 10, 2002, they admitted to shredding documents. On March 14th, the Department of Justice indicted the entire firm for obstruction of justice. Their clients fled immediately. By August 2002, Arthur Andersen, one of the Big Five accounting firms with 85,000 employees worldwide, surrendered their licenses and ceased operations. 28,000 U.S. employees lost their jobs because of one client. Chapter 5. Orange jumpsuits and new rules. The trials began in 2004. Andrew Fastow pleaded guilty to conspiracy and agreed to testify against his former bosses. He served 6 years in federal prison. His wife Leah, who had been an assistant treasurer at Enron, served 1 year for tax crimes. Together, they forfeited $30 million. Jeffrey Skilling was convicted on 19 counts of conspiracy, fraud, and insider trading. He was sentenced to 24 years in prison and fined $45 million. The man who had once lectured at Harvard Business School about innovation spent 12 years in federal prison before being released early in 2019. Ken Lay was convicted on all counts, but died of a heart attack on July 5, 2006, before sentencing. Because he died before appeals were exhausted, his conviction was vacated. His victims never saw justice completed. The regulatory response was swift and severe. Congress passed the Sarbanes-Oxley Act in July 2002, the most significant change to securities law since the 1930s. CEOs and CFOs now had to personally certify their company's financial statements. Lying meant up to 20 years in prison. Auditors could no longer provide consulting services to their audit clients. Companies had to have independent directors on their audit committees. The accounting industry consolidated from the Big Five to the Big Four overnight. Every major corporation in America had to change how they reported finances. The cost of being a public company increased dramatically. Small companies now spent millions just to comply with regulations. But here's what's fascinating. Mark-to-market accounting, the technique that started it all, is still legal and widely used. After the 2008 financial crisis, banks used the same technique to value mortgage securities. The difference now is that regulators actually check the assumptions. The energy trading industry that Enron pioneered? It still exists and thrives. Companies like Goldman Sachs and Morgan Stanley took over Enron's trading operations. The idea of trading energy like securities wasn't fraudulent. Enron's execution was. Chapter 6. Your 401k is not a lottery ticket. So what can regular investors learn from Enron? Let's start with the most painful lesson, the retirement massacre. When Enron collapsed, employees lost $1.2 billion in retirement savings. But here's the detail that should make your blood boil. During the final 2 weeks before bankruptcy, Enron locked employees out of their 401k accounts due to administrative changes, while executives cashed out $116 million in stock. John Doe, a 58-year-old engineer, watched his 401k drop from $700,000 to $20,000 while literally unable to click the sell button. He had to postpone retirement by 15 years. This wasn't investing, this was corporate theft disguised as administrative procedure. Here's your first lesson. If your company ever restricts your ability to manage your own retirement account while executives are selling, that's not a red flag. That's a fire alarm. Get whatever money you can out immediately when the restriction lifts. Second, the company stock discount trap. Enron offered employees company stock at a 15% discount in their 401ks. Sounds great, right? Free money? But think about this. If your company fails, you lose your job and your retirement savings simultaneously. That's exactly what happened to thousands of Enron employees. Financial advisors now recommend keeping company stock to less than 10% of your retirement portfolio. I'd say 5% maximum. Third, watch for complexity hiding incompetence. When analysts asked Enron executives to explain their business model, the response was always some version of, "It's too complicated for outsiders to understand." Here's a truth Wall Street doesn't want you to know. Legitimate businesses can be explained in one sentence. McDonald's sells hamburgers. Microsoft sells software. Amazon delivers packages. If someone needs 45 minutes and a PowerPoint to explain how they make money, they probably don't. Fourth, the employee whistleblower pattern. Before every major corporate collapse, employees try to warn us. Sharon Watkins wrote her letter to Ken Lay 3 months before bankruptcy. Employees were posting anonymous warnings on Yahoo Finance message boards throughout 2001. They described the rank and yank culture, the accounting games, the fear of speaking up. Today, websites like Glassdoor and Reddit's various employee subreddits serve the same function. When employees are screaming warnings, listen. Fifth, understand the auditor conflict. Arthur Andersen made $25 million consulting for Enron and $27 million auditing them. How objective can you be about someone paying you $52 million a year? Today, thanks to Sarbanes Oxley, auditors can't provide consulting services to audit clients. But new conflicts emerged. Companies still pay their auditors, creating the same incentive to please the client. When reading financial statements, remember the auditor was chosen and paid by the company they're supposedly checking. Here's something that might save your retirement. The earnings quality test. Real businesses generate cash. Enron reported billions in profits but never had cash. They constantly issued new debt and stock to fund operations. If a company reports consistent profits but always needs more money, something's wrong. Look at the cash flow statement, not just earnings. Cash is fact. Earnings are opinion. Let me tell you about the smart money myth. Enron's investors included the most sophisticated institutions on Wall Street. The company's board included a Stanford accounting professor, the former UK Secretary of State for Energy, and the Dean of the University of Texas Business School. These weren't amateurs. They were experts who got fooled. Never assume that because smart, rich people are investing, an investment is safe. Smart people believed in Theranos, FTX, and Bernie Madoff too. The geographic concentration risk is another hidden lesson. Houston lost 4,000 millionaires overnight when Enron collapsed. Local restaurants, car dealerships, and real estate markets crashed. If you live in a company town, Seattle with Amazon, Detroit with automakers, San Francisco with tech, diversify your investments away from your local industry. When your neighbor loses their job, your house value drops too. Finally, remember that regulation is written in blood and poverty. Sarbanes-Oxley exists because 20,000 Enron employees lost their jobs. The SEC's whistleblower program, which now pays millions to tipsters, exists because Sharon Watkins was ignored. These rules weren't created by bureaucrats who hate business. They were created because real people lost real retirements. But here's the terrifying truth. It's happening again, just differently. Today's SPEs are called Special Purpose Acquisition Companies, or SPACs. Today's mark-to-market accounting happens in cryptocurrency and NFT valuations. Today's Enron might be hiding in plain sight with a different acronym and a charismatic CEO on social media. The difference between Enron's victims and you? You're not sleeping through it anymore. You understand that when executives sell while employees buy, when accountants make more from consulting than auditing, when simple questions trigger angry responses, you now know those aren't just red flags. They're the same warning signs that appeared before Enron turned $70 billion into dust. Your 401k is not a lottery ticket. It's not a bet on your company's stock price. It's your future ability to eat, pay for medicine, and keep a roof over your head. Protect it like your life depends on it, because one day, it will. If stories like this, where we uncover the economic events that shaped our world while most people weren't paying attention, fascinate you, please like this video and subscribe to the channel. because we're just getting started with these financial, educational mysteries.